I am Sarah Merard, aka The Mortgage Mom. Welcome back to my channel. If you're new here, welcome. What you're going to expect is mortgage tips, home buying hacks, and I'm also a mom of a toddler, and I've learned a lot by things that we have done and experienced. So if you like this video, please like and comment, subscribe to my channel. I'd love to know more about you guys and have you guys comment on my videos. So today we are going to talk about debt to income ratios. So when you buy a house, this is one of the more important numbers that a lender looks at. They want to know how much monthly debt you have compared to how much money you make a month. So when we look at those things, the debts that we look at aren't typical of if you're making your own budget. So the debts that we look at are coming from your credit report. So we're going to look at any car payments. We're going to look at credit cards. We're going to look at if you do have a current mortgage, any personal loans, student loans, those things that come from the credit report. That's what we're going to factor into your debt to income ratio. So once we look at all of your debts, then in my previous video on how to get pre-approved, we talked about those income documents to prepare. So then the lender looks at how much money you make a year. The caveat here is that we look at your gross income, not your net. So your gross income is basically before taxes get taken out, any health insurance, 401k, any of those deductions. We're going to look at what you make before that. So for easy numbers, let's say you make $60,000 a year. We're going to give you $5,000 a month for your gross income number. So when we look at these debt to income numbers to qualify you, we look at the percentages. So there are some loan programs that you can only go up to a certain percentage of debt to income ratios. The reason behind that is obviously you don't want to have a ton of debt to increase that percentage. They want to make sure that you're not going to default on your loan or anything like that. So that's why the debt to income ratio is so important. And it also gives us an idea of where you should be looking in that price range. So when you make your budget, we look at all the things that come from the credit report. The one thing that I want to tell you that the lenders don't look at and they don't factor in is your utilities, your Netflix bill, your cell phone bill, your groceries, if you have any kids, your daycare, things like that. So that's why I want to make sure that everyone knows what the lender looks at as far as debt to income ratios. But then you also have to factor in those things, those monthly bills that we don't count against you. So I'm obviously a lender, and I will more than happy go through a budget with you. We have an Excel spreadsheet that actually puts in TV, cable, internet, that kind of thing, so that you can actually truly see what your budget is versus what the lender's looking at. So the reason I wanted to explain that to you guys is because when we look at income and your gross income, a lot of times I will pre-approve someone for way more than what they actually feel comfortable with for a mortgage payment. And that is because we use your gross income. So that's why it's really super important to talk to a lender about your budget first before you go shopping, because there are factors that come into your budget that you may not have accounted for. And it could really mess up your shopping experience on how much you can afford. So please, please, please talk to your lender about your debt to income ratios. That way you know exactly what you're getting yourself into. And like, comment on this video. Please subscribe to my channel. I'll have more info for you. Thanks.